I want to start with a question that looks simple on the surface but is not simple once you understand the whole system. Should you pay off your mortgage early or should you invest the money instead? People argue about this question because it touches more than arithmetic. If it were only arithmetic, the answer would be easy. You would compare one rate to another rate, pick the larger number, and move on. But money decisions are rarely only numbers. They are also risk, they are timing, they are psychology, they are control, they are the ability to sleep at night when the world changes in a way you did not expect. That is why this question creates strong emotions. One person says debt is dangerous and the safest thing in the world is to own your home free and clear. Another person says a low fixed mortgage is one of the most valuable financial tools an ordinary person can have. Both people can be right depending on the circumstances. The mistake is not choosing one side or the other. The mistake is pretending there is one answer that applies to every person in every environment. In my life, I have learned to think in principles. A good principle does not tell you what to do in every case. It gives you a way to see the situation clearly. It helps you ask, what is the cause and effect relationship here? What are the trade-offs? What are the probabilities? What are the consequences if I am wrong? So I would not begin this problem by asking, should I pay off my mortgage or invest? I would begin by asking, what kind of debt do I have? What is my time horizon? What risks am I taking? And what kind of life am I trying to make more resilient? The simplest version of the decision is this. When you pay down a mortgage, you are earning a guaranteed return equal to the mortgage rate you no longer have to pay. If your mortgage rate is 6%, every dollar you use to reduce that debt is giving you something like a guaranteed 6% return before considering taxes and other details. When you invest instead, you are not getting a guarantee. You are getting a probability distribution. Historically, the markets have offered higher returns than most mortgage rates, but those returns do not come in a smooth line. They come with drawdowns, long periods of discomfort, bad timing, and the possibility that you will need money when your portfolio is temporarily down. That is the real comparison: guaranteed return versus uncertain return, control versus upside, lower fixed expenses versus more invested capital. That is why the mortgage rate matters so much. It is the first and most obvious signal. It is not the whole answer, but it is the right place to start. When you look across the way major firms and planners tend to model this decision, a pattern appears. There are three broad zones. The first zone is the low rate zone. This is usually the 0 to 4% range when a mortgage is sitting at 2%, 3%, or even around 4%. It is usually a very cheap form of long-term fixed debt. Historically, stocks have returned somewhere around 7 to 10% over long periods, and even more conservative portfolios have often returned around 5 to 7%. So if you are paying 3% and your money has a reasonable chance of earning more over the long run, the math generally favors investing, but the deeper reason is not just the spread between 3% and 7%. The deeper reason is inflation. A fixed-rate mortgage is one of the few obligations where time can work in your favor. The payment is fixed in nominal dollars, but the dollars you use to make that payment usually become less valuable over time. If inflation averages 2 to 3%, then a 3% mortgage has a real cost that may be very close to zero. This is an important concept. The loan does not change, the payment does not change, but the world around the loan changes. Wages tend to rise over time. Prices rise, asset prices may rise, rents may rise, but your mortgage payment stays the same. That means that the same payment that felt heavy in the beginning can become less burdensome as the years pass. In that sense, a low-rate fixed mortgage is not just cheap debt. It can become cheaper in real terms the longer you hold it. That is why I would be cautious about rushing to kill a 3% mortgage simply because the idea of debt feels uncomfortable. The emotional satisfaction may be real, and that matters. But the economic trade-off can be large if you pay off a very low-rate mortgage early. You may be giving up decades of compounding in assets that could have grown at a higher rate. You may be converting liquid capital into home equity, which is valuable but not flexible. You may be making your balance sheet feel safer while reducing your optionality. Optionality is worth a lot. People often underestimate that a paid-off house gives you security, but cash and investments give you flexibility. If an opportunity appears, if a job changes, if a market crashes, if you need liquidity, money inside a brokerage account is easier to use than money trapped inside walls and a roof. So in the low-rate zone, the principle is usually this. If your mortgage is cheap, fixed, and your time horizon is long, the mortgage may be worth keeping while you let your capital work elsewhere. Then there is the second zone. And this is where the decision becomes harder. This is the gray zone, often around 4 to 6% here. The math is no longer one-sided. A 5% or 5.5% mortgage is not obviously cheap in the same way a 3% mortgage is cheap, but it is also not obviously expensive in the same way a 7% mortgage is expensive. This is where taxes begin to matter more. Market volatility matters more, your behavior matters more, your age matters more, your retirement timeline matters more. If your mortgage is 5.5% and your realistic after-tax investment return might be 5.5% or 6%. You are no longer comparing something obviously bad to something obviously good. You are comparing two outcomes that may be very close. And when the numbers are close, the risk differences become more important than the return differences. This is a principle that applies far beyond mortgages when two choices have a similar expected return. I care a lot about the shape of the risk. I care about which one gives me more resilience. I care about which one leaves me better able to survive bad outcomes. A 6% market return and a 6% guaranteed return are not the same thing. The market return might be higher over time, but it can be negative at the wrong moment. The guaranteed return from paying down debt does not depend on the market. It does not depend on investor sentiment. It does not depend on whether the next 5 years are good or bad. That does not automatically mean you should pay off the mortgage. It means you should stop treating the decision as a simple spreadsheet question. The third zone is the high rate zone. Once a mortgage rate gets to around 6% or higher, the argument for paying it down becomes much stronger. At that point, every extra dollar you put toward the mortgage is eliminating a liability that is compounding against you at a meaningful rate. A 6.5% guaranteed return is hard to match after taxes, risk, and volatility. That does not mean investing cannot outperform it. Over a long enough period it might, but the certainty of debt reduction becomes valuable. At lower rates, the question is mainly about maximizing growth. At higher rates, the question shifts toward protecting the plan. That distinction matters. Wealth is not only built by maximizing returns, wealth is also preserved by reducing the things that can force you into bad decisions at bad times. A high mortgage payment is one of those things. It is a fixed obligation. It does not care whether your investments are down. It does not care whether you lost income. It does not care whether the economy is in a recession. The bill arrives every month, so when the mortgage rate is high enough, paying it down improves resilience. It lowers future obligations. It reduces the amount your portfolio needs to support. It makes your financial life less fragile. That word fragile is important. A person can have a high net worth and still be fragile if their fixed expenses are too high. A person can have a smaller net worth and be more resilient if their obligations are low and their liquidity is strong. So the right question is not only what return can I get? The better question is, does this debt make my life more fragile to answer that? Well, you have to adjust the comparison for three things. The first is after-tax real return. People often say the market returns 7% after inflation, or 8%, or 10% nominally. But what matters to you is what you keep. If you are investing in a taxable account, you may owe taxes on dividends, capital gains, and distributions. Even if you are using efficient index funds or ETFs, there can still be some tax drag. So a 7% return may not be 7% after tax. It may be closer to 5.5% or 6% depending on your tax bracket, state taxes, dividend yield, turnover, and the kind of account you are using. But account type matters a lot. If the investing happens inside a Roth IRA, Roth 401k, traditional IRA, or other tax-advantaged account, the comparison changes. Capital gains are not being taxed every year. Dividends are not being taxed as they occur. The money grows tax-free or tax-deferred. In that case, the return you see may be much closer to the return you keep. So a 3% mortgage compared with a 6% after tax. Return still favors investing. A 5.5% mortgage compared with a 5.5% or 6% after-tax return is much more balanced. A 6.5% mortgage compared with uncertain after-tax returns begins to favor paying down debt, especially if you are closer to needing the money. The second adjustment is risk. This is where people often fool themselves. They compare the mortgage rate to the long-term average market return, but they ignore the path. The path matters. A market can return a reasonable average over 20 or 30 years, while still giving you terrible results over the exact years when you need to withdraw. That is sequence of returns risk. If a major downturn happens early in retirement and you are withdrawing money from the portfolio to make mortgage payments, the damage can be more serious than the average return suggests. You are not just watching the account go down. You are pulling money out while it is down. That can reduce the recovery power of the portfolio. When you are young, Market volatility is usually an inconvenience. When you are retired, volatility can become a threat to the plan. That is why the same mortgage rate can mean different things at different ages. A 6% mortgage at 35 is not the same as a 6% mortgage at 65. At 35, you may have decades to recover from volatility. You may be in your peak accumulation years. Your human capital, meaning your ability to earn future income, may be high. Investing may still be the better long-term path, even if the mortgage rate is not low. At 65, the same mortgage may create pressure. It may force higher withdrawals. It may make the portfolio more vulnerable during bad markets. It may reduce your sense of control in that situation. Reducing or eliminating the mortgage can make the whole system safer. The third adjustment is time horizon. Time is one of the most powerful variables in investing. When you have 20 or 30 years, compounding can overcome a lot of volatility. Historically, broad markets have had a very high probability of producing positive returns over long horizons. That does not mean the future is guaranteed. Nothing is guaranteed, but the longer the time horizon, the more powerful the investment case becomes. When you are close to retirement, the objective changes. The objective is no longer just to accumulate the largest possible number. The objective becomes to build a durable system that can support your spending under different market conditions. That is very different. If you have a mortgage payment in retirement, your required withdrawals may be higher. Higher required withdrawals can increase the chance that you sell investments in a downturn. Selling in a downturn can reduce the portfolio's ability to recover. This is the chain reaction that matters. So when I think about debt near retirement, I do not only look at the interest rate, I ask, does this debt increase the amount I must withdraw from my portfolio each year? Does it reduce my flexibility? Does it force me to be a seller when markets are bad? If the answer is yes, paying down the mortgage may be less about return and more about survival of the plan. That is why we can think about this decision in two broad paths. The first path is keeping the mortgage. This is the growth and optionality path. It tends to make sense when the mortgage rate is low, the borrower has good liquidity, the time horizon is long, the investor is not dependent on the portfolio for near-term income, and the person can tolerate market volatility without panicking. In that situation, the mortgage is relatively cheap, and capital can remain invested. The goal is to let compounding work. You are choosing growth potential and flexibility over the certainty of being debt. Free, the second path is paying it off. This is the stability and control path. It tends to make sense when the mortgage rate is higher, when retirement is closer, when the portfolio is already being used for income, when fixed expenses are tight, or when the debt creates emotional pressure that affects decision-making. In that situation, the mortgage is not just a number. It is a monthly claim on your life. It is an obligation your portfolio has to support. Removing it can reduce required withdrawals, reduce sequence risk, and make the plan more durable. This is the difference between a growth-optimized decision and a resilience. Optimized decision. A growth-optimized decision asks, what has the highest expected return? A resilience-optimized decision asks, what keeps me in the game under bad conditions? Both are valid. The right answer depends on the life stage, the rate, the liquidity, the tax situation, and the person there. Is another mistake people make. They assume this must be an all-or-nothing decision. It does not have to be. In the gray zone, a hybrid strategy can be very sensible. You can invest part of the extra cash and put part of it toward the mortgage. That reduces regret. It balances the math with psychology. It keeps the plan flexible. If the market does well, you still participate. If the market does poorly, you have still reduced debt. If mortgage freedom matters to you emotionally, you are making progress. If compounding matters to you financially, you are still allowing it to happen. This is how many good decisions work. You do not need to maximize one variable and ignore all others. You can build a balanced system. Let me walk through the kind of example that makes this clear. Imagine a $400,000 mortgage, a 30-year fixed loan at 6.5%. The monthly payment is roughly $2,500. Over 30 years, the total paid is about $910,000, and the total interest paid is more than $500,000. That is a serious amount of money, so it is natural for someone to say, I want to destroy this debt as fast as I can. Now suppose you add $500 a month toward the mortgage for the first 10 years. That extra payment can cut the loan down by roughly 6 or 7 years and save more than $100,000 in interest. That is real. That is guaranteed. That is not a theoretical market return. But now compare the opportunity cost. If the same $500 a month is invested for 10 years and earns 7%, it might grow to around $86,000 by the end of that 10-year period. If it is then left alone for another 20 years, it could grow to something around $330,000 by age 65. So one path saves roughly $100,000 to $120,000 in mortgage interest and pays off the loan years early. The other path may build roughly $330,000 of invested wealth, but the second number is not guaranteed. The first one is the trade-off in its purest form. One path reduces a fixed liability. The other path builds a variable asset. It is not enough to ask which number is higher. You have to ask which kind of uncertainty you can live with. You have to ask whether the higher expected result is worth the additional risk. You have to ask whether you will stay disciplined when the market falls. Now look at the same decision through the lens of age. If the person is 35, they have time. Time is their great advantage. They may have 25 or 30 years before retirement. They may be entering their highest earning decades. They can absorb market volatility because they have many years for compounding to work. For a 35-year-old, even with a 6.5% mortgage, going all in on mortgage payoff may not be optimal if it prevents investing for several years. Those early investment dollars are very powerful. A dollar invested at 35 has much more time to compound than a dollar invested at 45 or 55. At 35, I would be careful about sacrificing the most powerful compounding years just to reduce debt faster. It may still make sense to pay extra toward the mortgage, but the better balance may lean toward investing. Maybe the person puts most of the extra cash into tax-advantaged accounts and investments, while making modest extra mortgage payments. That way they preserve compounding while still capturing some of the guaranteed return from debt reduction. Now consider a person at 45. The time horizon is shorter. Retirement is no longer far away. Market downturns matter more. Sequence risk is beginning to come into view. The portfolio may be larger, but the recovery window is smaller. For a 45-year-old with the same 6.5% mortgage, I would think more carefully about reducing fixed expenses before retirement. Maybe the split becomes closer to balanced. Perhaps 60% of the extra money goes toward investing and 40% toward the mortgage, or even 50 divided by 50 depending on their savings, job security, liquidity, and retirement timeline. The key is not the exact percentage. The key is understanding the shift at 35. Time is the dominant asset at 45. Balance becomes more important. Near retirement, resilience becomes increasingly important. This is why blanket advice is dangerous. The same mortgage can be a tool for one person and a burden for another. There is also the emotional side. Some people feel deeply unsafe with debt for them. A mortgage is not just a financial liability. It is a psychological burden. Paying it off gives them peace, and that peace changes their behavior. They sleep better, they make decisions more calmly, they do not panic as easily. You cannot always quantify that, but just because something is hard to quantify does not mean it has no value. In my own thinking, I try to recognize that emotions are data too. They are not always accurate, and they should not run the whole system. But they tell you something about your ability to follow a plan that has the highest expected return but causes you to panic during volatility may not be the best plan for you. A plan with slightly lower expected return that you can follow consistently for decades may be much better. The most important thing is not theoretical optimization. It is reliable execution. So if paying off the mortgage gives you the control and stability you need to stay rational, that is not irrational. It is a legitimate preference. But there is a danger on the other side too. Some people pay off a low-rate mortgage because they hate debt, but then they leave themselves cash. Poor investment, poor and less flexible. Their house is paid off, but their liquidity is weak. Then if a major expense appears, they may need to borrow again or sell assets under pressure. That is not true resilience. A paid-off house with no liquidity can still be fragile. A mortgage with strong liquidity and investments can be resilient. So again, we return to the principle. You have to look at the whole system. If your mortgage rate is below about 4%, the math generally leans toward keeping the mortgage and investing, especially if you have a long time horizon and strong liquidity. If your rate is above about 6%, the case for paying down the mortgage becomes much stronger, especially if you are closer to retirement or if the payment makes your plan fragile. If you are between 4% and 6%, you are in the gray zone. And the answer depends heavily on taxes, account type, risk tolerance, age, liquidity, and personal psychology. And if you are uncertain, a hybrid approach may be the most robust decision. Put some money toward investments, put some money toward the mortgage, keep emergency reserves, keep contributing to tax. Advantaged accounts. Do not create a plan that only works in one future because the future will surprise you. That is one of the deepest lessons of money. The future will not unfold exactly the way your spreadsheet says it will. Markets may underperform. Inflation may be higher or lower than expected. Mortgage rates may change. Jobs may change. Health may change. Family needs may change. Your emotional relationship with debt may change. Good planning is not about predicting one future perfectly. It is about being prepared for several futures reasonably well. If you invest instead of paying off the mortgage, make sure you can stay invested when markets fall. If you pay off the mortgage instead of investing, make sure you are not destroying your liquidity or abandoning long-term compounding. If you split the difference, make sure the split is intentional, not just a way to avoid thinking. The mortgage decision is not really about whether debt is good or bad. Debt is a tool. A low fixed rate mortgage can be useful. A high rate mortgage can be dangerous. A mortgage near retirement can create pressure. A mortgage early in life can create leverage and allow investment capital to compound. The question is not, is debt bad? The question is, what role is this debt playing in my system? Is it helping me build wealth, or is it making me fragile? Is it cheap, fixed, and manageable, or is it expensive and stressful? Is it giving me optionality, or is it limiting my freedom? The same dollar can do different things in different systems. A dollar used to pay down a 3% mortgage is not the same as a dollar used to pay down a 7% mortgage. A dollar invested at 35 is not the same as a dollar invested at 65. A dollar in a Roth account is not the same as a dollar in a taxable account. A dollar in home equity is not the same as a dollar in cash. Understanding those differences is what separates a reaction from a principle. So when people ask me what they should do, I would not give them one answer. I would give them a framework. I would start by identifying the mortgage rate and comparing it with a realistic after-tax investment return based on where and how the money would actually be invested. Then I would look at time horizon, liquidity, retirement risk, and whether the debt makes the overall plan more fragile. I would also be brutally honest about behavior. If you know you will not invest the difference, then the argument for investing is only theory. Paying down the mortgage may be better than spending the money. But if you truly will invest consistently, then the comparison becomes real. That last point is important. Many people say they will invest instead of paying off the mortgage, but then they do not invest, they spend the difference. In that case, the best mathematical answer failed because behavior broke the system. The right decision is the one you will actually execute if you keep the mortgage. Set up automatic investments. Do not leave the money sitting in your checking account waiting to be consumed by lifestyle. If the plan is to invest, make it mechanical. If you pay down the mortgage, protect your emergency fund first. Do not put every extra dollar into the house while leaving yourself unable to handle a job loss or medical bill. If you use a hybrid approach, define the rules. Maybe every month a fixed portion goes into investments and a fixed portion goes toward principal. Or maybe bonuses go toward mortgage and monthly savings go toward investments. The exact formula matters less than the discipline. When systems are clear, behavior improves. When behavior improves, outcomes improve. In the end, the mortgage question is a test of priorities. If your priority is maximum expected growth and you have time, liquidity, and discipline, investing may be the better path. If your priority is stability, lower fixed expenses, and protection against bad timing, paying off the mortgage may be the better path. If your priority is balance, the hybrid approach may be the most sensible. There is no single right answer because people are not all in the same position, but there is a wrong process. The wrong process is making the decision based only on fear, only on greed, only on someone else's rule, or only on a headline. Use the data, respect the math, respect risk, respect your own psychology, and then design the plan that gives you the best chance of staying rational for decades, because that is what financial success really requires. It requires staying in the game. It requires avoiding forced mistakes. It requires building a system that works when things are good and when things are bad. Paying off your mortgage can be a very good decision. Investing instead can also be a very good decision. The difference is not moral, it is structural. The right choice is the one that makes your whole system stronger. If your low-rate mortgage is giving you cheap leverage and your investments are compounding, that can strengthen the system. If your high-rate mortgage is draining cash flow and increasing risk, paying it down can strengthen the system. If your retirement plan is vulnerable because the mortgage payment forces larger withdrawals, reducing or eliminating that payment can strengthen the system. If you are young and paying off the mortgage too aggressively prevents you from building liquid investments, that can weaken the system. That is the way I would look at it. Not as a debate, not as a slogan, not as a simple rule, as a system of trade-offs. And once you see it that way, the decision becomes much clearer. You are not trying to win an argument on the internet. You are trying to build a life that can handle reality. Reality includes opportunity. It also includes uncertainty. The best financial decisions are the ones that let you benefit from opportunity without being destroyed by uncertainty. That is the balance. That is the principle. And that is why the answer to whether you should pay off your mortgage or invest is not just about the mortgage rate. The rate matters. But it is only one piece. The real answer lives in the relationship between rate, taxes, inflation, time, risk, liquidity, behavior, and peace of mind. When you understand those relationships, you stop asking for a universal answer. You start building the right answer for your life.